Well, hello everyone, and welcome back to the Man and Machine here with PeakBot team and Mark Phillips from Harvested Financial, episode 117 this morning. We are feeling like I need music. We're going to get a little bit going here in the background. Ben, Mark, gentlemen, how we doing?
Hanging in there, both health-wise and account-wise.
Just getting by. Ben's still fighting flu A, while the rest of us are fighting this stock market. Mark, how you doing, man?
It feels like ages since an enormous amount of things have happened since we last talked. It feels like years have passed in the last week.
Yeah,
it's crazy. Yeah,
market's been busy. Mark has been busy, I'm sure, but the market has been busy, and lots to discuss today. Of course, we'll take a quick look at PeakBot picks, very brief overlook there. We got stocks in real life, talking about CVS today. Should be a good one. And then we're going to be learning a little something with Mark about diversifying your portfolio. So, let's get into it, guys. I think I don't know, the daydreaming music doesn't
cut it. Do we want to cover who won PeakBot picks?
Do you ask because it was you?
Yes.
Okay. Yeah, let's talk about it. I can pull up the tracker here. Let me share my screen and we'll get into it. So PeakBot picks last week was week 7. Credit spreads from our trend spread watch list selected on the 28th, expired on the 4th. Last week, I personally went 2 for 3, just squeaked by with a profitable week on the 3 picks of $6, but I was correct on IEF put credit spread and a CMG call credit spread and lost on my Verizon put spread. You guys can see my picks there for this week. Ben, I think Thomas went 2 for 3 as well. We'll take a quick look at his document. Okay, yeah, not fully updated, but pretty sure he went 2 for 3.
I think
Ben, well done. How about you talk through your picks here quickly?
Cool. So I went with some tighter spreads this last week. I figured there was going to be some additional volatility in the market. I wound up going pretty much all bearish plays. That gold play is a bullish play, but gold being my hedge against the market turned out to work for me. I did take profit on that early, which would have turned around on Friday and turned into a loss. So thank you, Trend Spread, for setting that take profit order for me. And then I wanted to highlight XOM, which was from 2 weeks ago. That was a losing position. However, I let myself get assigned negative shares there. So I was in a short position. You can actually change that, Dillon, from open to win. I adjusted my strike prices several times. And as you can see in the column 2 over from where you're at, I wound up paying some premium. I paid $255 in premium to get a better strike, but I overall net a $45 win. So there were some adjustments along the way. I was selling puts against my short shares, which is kind of like the reverse of the wheel when you sell a covered call against the shares that you do own. So XOM did drop below my strike price. Those negative shares, I was forced to buy them back and turn that loss into a win. And I'm doing the same thing with XPEV at the moment. Still rolling that. I've got a position open this week at the $20 strike. I was assigned at the $20.50 strike, so I will take a small loss on the shares. But as you can see, I've collected a lot of premium there. So when it comes to trading the trend spread bot, it's not bad to blend man and machine. That's the whole point of talking about this right now.
Sure is. Yeah, and I will say, can't discredit the effort and good trading for flipping this to a win. Was it discussed with the other members of the PeakBot team if we can go and revert back to wins?
Well,
no.
For that week, I'm not gonna change anything. But I'm treating it as my trend spread trade journal now.
No, it's absolutely, again, I can't argue with it. It's well done. We're here to celebrate good trading, man and machine. Will Thomas have a thought on it? Yes. But no, I'm just kidding. So great job on PeakBot picks. Love seeing anybody turn losers into winners. So well done. You can keep up with us. We go in depth on that on our Friday show with me, Ben, and Thomas. But let's get into, well, do we want to get right into stocks in real life, or do we want to talk about this market and how people are maybe approaching it? Oh boy, my banner's incorrect.
Let's talk about it, because we talked about it a bit on Friday, but Mark wasn't with us on Friday. So Mark, give us your 2 cents on what's going on here.
Whew. If I had 2 cents on what's going on here, I'd have a lot more than 2 cents.
Yeah.
But I think this is just kind of I don't want to say classic, because no kind of meltdown is classic. Like right there, Tolstoy said something about this, that like happy people are all the same, but unhappy people are all unhappy in their own ways. Like every market crash is different and unique in its own way. So it's hard to compare this to 2008 or 2004 last August. So obviously something different is going on here, except for the fact that it definitely, we look at some of these candles and there's definitely panic in the air, right? Like that is obvious to everyone out there. And I think the main takeaway I have when the market's behaving like this is every decision you make is going to have an even greater impact. So you want to be really careful about the potential changes you can make now, right? Because emotions are running hot, prices are moving fast. So making significant changes or adjustments right now, you got to be really careful about, the risk of making a really good or really bad decision in a market like this. So cool heads and, take time to, be really careful about changes you're going to make in a market environment like this.
Yeah. And we've got futures dipping below 5,000 this morning. So will be interesting to see what happens when the market does open. But based on what's been happening on other continents, not looking hot today.
No, I mean, when we opened at 6 p.m. Eastern last night, futures, they were down. I think the low of that candle actually might be the low of the overnight, which was down to 48.50. And we're, 150 points off that. So like, you don't see 150 point rallies that much, but you also don't see them still leaving you down 100 points.
Yeah. It's messing with people's heads. It is going to be interesting to see how things open up today. I mean, Mark, you mentioned something earlier, right? Like really time to be a bit more hands-on, especially if you're going to be, in shorter term trades. Even our PeakBot picks contest, Mark, I'm looking at the watch list, at 11:30 for entries at 12, and we go live on our show. That 30 minutes to me anymore, I can't do it. Like I can't leave 30 minutes of prices to change and premiums and strikes. And, my fills were not exactly what I wanted. So yeah, got to be keeping a closer eye on everything you're doing here. Speaks to man and machine. So, well, with all of this happening, where do we move forward? How does one approach the market week to week right now? I mean, is there any light at the end of the tunnel short term here? What do you guys think?
I think it comes down to, first of all, know what you're trading, right? Like there's a big difference between making an adjustment to your 401k, an adjustment to your long-term positions, and and making adjustments to your opportunistic trading, right? So I think everyone looks at their 401k balance. They look at whatever their long-term investments are, and they get scared because you're down 20% in 3 days or something like that. Mm-hmm. That is the stuff that you really want to sit on your hands and be patient about and not make quick adjustments. To not confuse the opportunities in the market right now with what's going on with your long-term investments. That I think muddling those two is the first way to make an error in trading this market. So if you're going to get out there and make some opportunistic trades, right, because it is in these dislocations where we see lower liquidity, less efficient pricing, more market movement, really make sure you know that and keep that isolated as a short-term trade. And that's why I like using a bot for something like that, right? That I can allocate money to a bot that is going to look at this market and capture some opportunity, and treat that very differently from being like time to rebalance my Russell and S&P allocation in my 401k. So Vol's moving fast, underlines are moving fast. There's setups out there, but you got to be tactical about them.
100%.
Yeah. I was trying to think over the weekend, like what bot am I going to be trading? throughout all of this. And for me, I've been trading Max's premium grab strategy, and I'm kind of putting my own twist on it where I'm not actually holding the position overnight. So the premium grab, what it's doing is it's taking either IWM, QQQ, or SPY, buys 100 shares. If you don't own the shares, if you're running 1 unit on this, buys 100 shares right after the open, and it'll also sell a covered call against that. So you're collecting premium, you're hedging your downside a little bit for the day. Now, where I put my own twist on it is if price starts moving down, and we're in the afternoon in the day, I'll actually adjust that strike price down. So I want to, at the end of the day, I want that call to be in the money. I want that overnight protection by not being in the market, right? So I want to avoid that overnight exposure. So what I've been doing is I've been adjusting down. I've been collecting more premium from adjusting down, and capturing whatever extrinsic value is still there on those at the money strikes towards the end of the day. And it's been working out well, actually. And the title of today's episode is SPX is down, my account is up. My account actually is up because of that strategy. And because of King Condor, actually, now that I think about it. King Condor had at least one nice win last week, and then it was off for most of the week because of VIX.
Which, just to highlight, that's an amazing attribute of King Condor, right? That it is looking at these markets, it's volatility environment aware, and it's only going to enter into a short options trade if the volatility indicators are saying this is the right setup, right? It's being choosy about when it sells, because just because vol is high does not mean it's a sell, right? We've talked about that before. Like, just because you collect 75 cents on a dollar-wide Condor, like, more likely you're going to lose 25 cents than win 75 cents. That you got to be real careful about when you're shorting high vol. You know, it's not just a simple mean reversion thing. You've got to use the kind of indicators and market awareness that something like King Condor has.
Yeah, I love that. You're totally right. I love that feature, and I love that the King Condor is going to be off today. I just pulled up VIX here on screen. I didn't even look at this yet today. It looks like we've got the open numbers already. By the way, Mark, what time does that come out? Because I'm not 100% sure. Is it 8:30 Eastern?
I believe
pre-market for VIX.
Well, so they have the overnight session, right? They have the GTH or global trading hours. So VIX has been trading since I think they opened when futures opened the night before. So I think VIX has been trading since 6 p.m. Eastern last night.
Yeah, I'll have to see what time this price gets posted, but it looks like we opened today at $60 on the VIX, which is crazy. So King Condor, if we're over 29.95, we're not trading.
We're not might trading. Be a little bit.
My guess is that 60 print was when, because like I said, at 6 p.m. last night, we were down to 48.50 in the ES futures. So that probably roughly corresponds to, that was like a 250 point dip. So that roughly corresponds to what I would guess would make VIX 60.
Gotcha. We'll figure that out. But so King Condor will not be trading. But back to the premium grab strategy and the way that I've been trading it, we're actually going to make a bot that puts that twist on it. We're going to call it the daily covered call strategy, where there's not going to be overnight exposure. It will be a day trading bot because you will be closing your positions by the end of the day.
You have results you want to show on that, or wait?
We could. I gotta find my spreadsheet, but
take your time and don't feel pressure. We could, we're going to be rolling out this strategy, but the point is, I think it's really important for traders to know that this is a strategy. Ben, correct me if I'm wrong. It is man and machine here, but this is a strategy that is generally speaking bullish on the market, right? Daily, we are, selling covered calls, buying shares, but Ben's adjusting it, not taking any overnight exposure. But this is a market or a strategy that is trading with the market, if you will, long term, but still winning in this pull down, in this last few weeks here. So Ben, walk us through it.
This is my first month of trading, so just 21 trading days. So it did bleed into April just a bit, but I wanted to get a good sense of what 1 month could look like. And just for context, I screenshotted the monthly chart. And I'm trading IWM. So all of these trades are IWM. So I screenshotted IWM throughout the month just so we can see like where we started and where we ended. And overall, I think IWM the high was at 209 down to 295. So that was like a 15-point swing on a $200 ticker. So that was about a 7.5-point swing from top to bottom. So even with that type of volatility, I was able to pull the results that you see here in column H. So you can see on winning days, the wins are pretty nice. I'll get you an average here in just a second. The average win is about $130, which is pretty nice. And then the average loss, and you could see that there's some numbers. The average loss was about 191, but you can see we're winning more than we're losing. The nice thing is you could see here, like on this day, I only made $6, but that's because there was some price action that was moving against the strategy, made some adjustments. I still pulled out a small win on that. And you can see here the past 2 days, I'm probably going to make a rule if VIX is up X% over the last day or so. Just don't trade the strategy. And I knew going into Friday and Thursday that it was probably not going to be a great trading day, but hey, we're doing this for science, right?
I was going to say, for man of the people, you're doing this for testing. You're going in sacrificing capital for the sake of it's a real not Robin Hood trading guy. It's a real Robin Hood life story. I like what you're doing, man. Mark, I got to ask. Go ahead, Ben. Sorry.
I was going to say to sum it all up, I needed about $21,000 to do this, to buy the shares of IWM. In month one, I made almost $1,200, which was a 5.5% return, which annualized is about 57% return. So I'm happy with that. And based on how the market traded and how IWM traded over the last month, I'm going to continue to trade this strategy.
I will too, and so should everybody else.
I'm going to come in and be the wet blanket here. I think this is one of those environment sensitive strategies, right? And I think we got to compare what the last month looked like to other months, because particularly as you're talking about rolling down, one of the catches of this, and this is kind of where that man comes in with the machine too, is that if we do see a turnaround rally, you get pinched very quickly on something like this. So while you can collect extra premium rolling down, if the market does turn around, you've got to be careful to not get yourself pinched in that scenario, because you could end up buying stock at 225, selling the 225 call, selling the 223 call. And if we rally back up, that does pinch this strategy. So I think it's worth noting what the risks are of, actively rolling and adjusting that short call position.
Yeah, absolutely. You definitely do miss out on upside. That's for sure. However, that's where I get conflicted about this strategy, right? Because if I was able to pull a 5% return in this last month of trading with the market, never mind the last 2 days, but with the market doing what it has done over the past month, if I'm able to pull a profit there, I mean, that yes, your gains will be capped in a bull run, but you're still winning. You would still win like every day in a bull run. So I would just imagine that what I've got on my P&L right here, these red days would probably just be green. So I think it would be a similar return. So that's where I'm conflicted. It's like if this strategy can make money in the market we've been in, it'll also make money in a bull market. Granted, it'll be capped because we are selling covered calls, but it'll still be making that consistent cash flow.
Let's get into it. Healthy debate. Mark, what do you think?
Without seeing the specific P&L of how you're making the money, it's hard for me to know exactly, but my spidey sense that there's not an all-weather 5% a month strategy, right?
Definitely.
I think that's I suspect the share losses are going to add up at some point. Just because, even with relatively high premiums that we have now, you're not, you're selling away that right tail and accepting the entire left tail, and those options tend to be relatively fairly priced over time.
Yep.
I guess time will tell.
And that's why, well, regardless, right? It should be a percentage of your portfolio, along with many other strategies, whether it be automated or manual, short-term, long-term. So, yeah, we're going to be keeping a close eye on those results. We'll likely be activating it, maybe even in a copy trading sense. We'll have to see. So, excellent. Ben, well done on that. Stocks in real life?
Let's do it. We
All right,
have CVS today.
Good one.
So CVS, bringing our heart to every moment of your health.
Too long.
Now, that's not what I think of when I think of CVS.
No.
I think of passport photos. What do you guys think of?
Mark, you first. I certainly have an answer. But
Passport photos is a good thing. I've gone to CVS recently for some like COVID and flu shots. Line those up there.
The Minute Clinic?
Yes.
yeah, I think expensive. I just think expensive. I when I lived in Maryland, we had a CVS literally outside our apartment door, right out across the street. And that's not fun because you end up buying salsa at CVS and you want to die because you paid 50% more than you would have paid at grocery store, etc. So I can't stand walking into pharmacies just thinking about having to maybe buy something that isn't medication. I can't stand it. That's what I think about when I think about pharmacies. But while we're talking about this, I'm going to look up how many locations CVS has because I am incredibly curious to know. And also if they're like as widespread as I think they are.
Well, that's actually, I was thinking very much along the same lines because I was down in the city this past weekend and pharmacies are a very regional thing, right? So like you walk around New York City and you're getting nothing but Duane Reads.
Yeah.
Like there's not a CVS in sight.
Yeah.
Whereas like out in the boondocks here, like I have a CVS, I have a Rite Aid, like, I think, and looking at a map of CVS, they're very Northeast and East Coast in general.
Pull it up if you have it. If not, that's okay.
I'm
trying
can't
to find
verify the accuracy of this. I only just pulled this up now, but
That's okay. We throw up fun facts that are completely GPT generated all the time.
Yeah. Absolutely.
This is not a recommendation or financial advice, but it's a CVS map. So yeah, very heavily concentrated in the Northeast.
Okay, but they're everywhere. I
Yes.
mean, they're
Maybe not
where
the
the people are. I mean, they're where the people are in the States. Wherever there's no dots, it's because there's no people.
But like I lived in Chicago for 5 years and I don't really remember seeing
Not up
that many CVS's there.
What was the pop? And when
Fair.
you say Duane Reade, you saying Walgreens?
Walgreens was all over the place in Chicago.
Okay.
I believe Walgreens might even be based out of the Midwest somewhere.
Okay.
But like Duane Reade is the New York City.
Okay, gotcha. I thought those two
Pharmacy.
were linked for some reason, Duane Reade and Walgreens. I thought one owned another. Maybe not.
Potentially.
But Rite Aid was one you said, Mark. That Rite Aid used to be, I don't know. I don't see any more of those. But Ben, we used to have one right in our town or two.
We did.
But okay, so CVS.
You're right that Duane Reade is owned by Walgreens, by the way.
I was just about
nice.
to say Duane Reade is owned by Walgreens.
Look at me, guys. I'm not often right about that stuff, but today I'll take a win. Okay, so let's get back into CVS. So we have our opinions on the life experience. Is it the preferred? And I'm sorry if we kind of have gone over this. Ben, if you're going to a pharmacy, is it a CVS?
Yes, because there's one right around the corner from me.
And is it in a larger department store, or does it stand alone?
It's a standalone CVS building.
Okay,
They've got a
interesting.
drive-through pharmacy, which is phenomenal.
Wow, that is nice because a lot of mine, like I live in a Target, or I don't live in a Target. I live near a Target that has the CVS pharmacy in it, and I use it because it's in the Target. But Mark, is it your go-to where you are or no?
I'm actually torn between a Rite Aid and a CVS.
Okay.
I end up going to the CVS because it is close to my favorite liquor store.
Nice.
Which is a little ironic that I'm going to the pharmacy and the liquor store at the same time. But
well, liquor used to be medicine, so
that's
yeah,
it's kind of the same thing.
I prefer my medicine in that form.
Yeah, I was gonna say still is medicine. Maybe just not sold in CVS. But okay, so let's talk about the stock. Truthfully, I'm not sure how much I've traded. I'm going to look now. Mark, you first. Experience with this stock?
Not much trading experience necessarily with this stock. I've been looking at some, stats on where we are now. Obviously, vol's exploding in CVS like it's, exploding in everything else. But stock actually has not taken that much of a beating recently. Where it looks like it's still holding relatively strong. Probably not impacted by tariffs all that much. That I suspect that's a rather local business.
Yeah. By the way, while we're looking at some stats here, and if you've already looked at it, that's fine. We typically do this. Any guesses on the IPO year?
Oh, that's a good one.
Feels like they've been around forever. But
yeah, I'm gonna say in the 90s. No, I'm gonna guess.
Yeah, I'd even go. I bet you like the 70s. I think they've been around forever.
Final guesses?
1991.
79.
Okay. If we're going Prices Right rules, Mark wins. It's 1984. Split is. But yeah, they've been around a while. Opened at a split adjusted price of $1.26. So that's fun. What's it trading at today?
A split adjusted price of $1.26, and we're trading at like 62 right now. It's not a bad return over 40 years, I don't think.
It looks like shares actually go back to 1968.
Whoa. Okay.
That's wild.
Yeah. Oh, do you know what it stands for? Oh, that's a good
CVS?
one. I never knew it. I just found out.
Oh, no, I don't. I have no idea, actually.
The V is a tough one.
It's funny because I disagree with it. It stands for Consumer Value Store. I don't agree with the value to the consumer at a CVS. Anything medical, I'm not going to think that, as well as anything else they're selling.
So they weren't actually a pharmacy originally, that they were more like just health and beauty products.
Founded in Lowell, Massachusetts. Good old Lowell, Mass. A year later, okay, so they were launched as the Consumer Value Store for a year and then changed their name to CVS. I have what looks to be like a 41-year stock split history on CVS. I'm not going to dive in too deep here, but Ben, have you traded this? I'm looking at my history here. I think it certainly appears on the trend spread watch list. I think it's a regular on the trend spread watch list.
I have not traded CVS, it appears.
I'm going to pull it up right now and see what we're working with. Let's see here. How about I'm curious to know how much like market share they have comparatively to other pharmacies, whether they be regional or national. Let's see. CVS is on the watch list right now on trend spread. And again, this is as of Friday's data. Ben, I'm going to pull my screen up. I'll have to take yours down. So this is the detailed trend spread watch list as of Friday, end of day. So again, when the market opens here in 30 minutes, we'll have some fresh data on this. But as of Friday, trending bullish, moderate risk compared to the other stocks on the watch list here. This is a nice expected value of 1.5. Win rate on this is floating right in the middle of what we would normally see, right around 75%, meaning we're grabbing right near the 25 delta. A good ROI, meeting 3 of the core 4. So this is a nice ROI and a lot of breathing room here. Here's why I don't trade it. On a $63 stock, $64 stock, it's got a $6 spread. At least how we're trading it on trend spread. For me, as of late, that's automatically out of my rules. It's too wide of a spread for me to be risking in 1 week, not knowing what in the world's going to happen. But right now, it's collecting $63 in premium on a $6 spread, trying to stay above 60 by Friday. Ben, do you have a chart up? I'm curious. Let's not even worry about it. But if people had entered it on Friday, that's where their strike would be on trend spread above 60. Let me pull you up here.
Bullish on 60.
Yeah, bullish above 60 for $63 in premium. The bought put is at 54. Here you go.
Okay. So that's that blue line right here. I'll make it.
And are these dailies?
Orange. Yeah, these are daily bars. So since
I
earnings,
like that.
Yeah, since earnings, we haven't been below $60.
Look at all those days. I mean, Mark mentioned it earlier, not a serious impact, obviously, the last few days, but man, that's a lot of breathing room. Whenever I'm looking at our watch list and I go and find a strike or something that looks appealing, I like to go and see how many days it's been trading above or below that number. And again, as Ben mentioned, since earnings, not even close. Damn. If I was a bit more risk tolerant, I'd be looking at that this week, just based on that trend. But what else
to pay attention here, though, is obviously these marks are into the close on Friday, but I look back at some kind of historical width data too. These markets are a little wide. So we're seeing like 60-cent wide in the weeklies, 30-cent wide in some of these like 20-25 delta options. Like, it's a tough spread to cross. So if you are going to get involved here, definitely pay attention to how tight these markets are, because it's going to make a big difference. You're giving away potentially dimes and quarters in executions here if you're lifting bids and offers.
Yep, absolutely. And while you were mentioning that, I was looking at other drug manufacturers, call it pharmacies, call it whatever you want. Curious to see if you guys trade any other of these pharmaceutical stocks. Is AbbVie one, ABBVIE? That one comes into play a lot. I see that as a popular stock as of late.
It's a very popular stock to trade. Yeah.
I'm just looking at other ones in the industry here.
I think Buffett made AbbVie popular.
Oh, really?
I think so.
Okay. Here we go. I'm going to share my screen, just looking at the largest companies in the industry here. Curious to know if you guys have experience with any of these. I wasn't familiar that Eli Lilly was pharmaceutical. Johnson & Johnson, obviously, call it a blue blood, if you will. Merck on here, Pfizer, Bristol Myers, Biogen. Other ones here as well, top performers. So yeah, high growth. Yeah, some good information here. But CVS not at least cracking these top lists, if you will. But any other thoughts on CVS or anything relating to the stock or the business? No? All right, let's keep it moving. Let's learn a little something. I think we hand the mic over to Mark here.
Yeah, this is an interesting day for the lesson about portfolio diversification with option strategies. So, the main reason we diversify in general is so we lose when everyone's winning. No, but seriously, it's so we don't lose as much when everyone else is losing more. But I think a fun adage about diversification in general is that it means you're always going to be unhappy. But your lows are going to be higher and your highs are going to be lower. And, what diversification helps with is both smoothing that return stream, but it also allows for better compounding, right? The smoother your return stream is, and the more kind of different return streams you have and different, hedges and positions that are offsetting, the more likely you are to continue to achieve that. So portfolio diversification, just at a fundamental level, is incredibly important. I know some of the investing greats like to say, put all your eggs in one basket and watch that basket closely. But truth be told, like, most investors can't realistically do that. That's why they're setting up trading bots. That's why they're allocating to SPY ETFs. At the end of the day, diversification is kind of the only free lunch that we have in the markets. And so when that specifically comes down to diversification with option strategies, I think the most important thing to remember is that an option is a hedge. It is a derivative on the underlying stock, and its movement will depend on its value, I should say, will depend on the movement of that underlying. And at the end of the day, where that underlying settles is what's going to, determine the final value of that option. Vol will kind of fluctuate, but at the end of the day, an option directly offsets movement in the underlying. So at the extreme, you can use options to diversify your portfolio by hedging risk. The most extreme hedge would be to put on a collar, where you're short a call, long a put, and you just completely neutralize it. So there you have an offsetting position in stock and options. You don't make money in the good times and you don't lose money in the bad times. So, that's one way to completely hedge your risk. But more likely, I think what people tend to use options for is to develop either, a more nuanced risk profile, or to potentially generate, alternative streams of, return by using the options. Options move up and down with stock movement, but they can also, depending on the strategy, be a diversified source of returns by essentially trading the volatility component of that option. So, like Ben was talking about a little bit with covered calls, by selling that covered call in an underlying, or selling a covered call in an underlying, you can generate additional premiums. You give away the upside, and that's my concern with rolling down aggressively a strategy. But you are ultimately paid for that. And so if you want to look at that strategy and you want to evaluate whether these options truly are expensive, whether the delta is going in the right direction, also padding your account with that potential income, those overpriced calls or those directionally correct calls, can add, an alternative revenue stream to your portfolio. As a speculative or leverage type strategy, options can give you orthogonal returns to the market. Something to be, of course, fairly careful with here. Generally when diversifying, we want to keep the most volatile components relatively small. So if you are speculating with options, if you are leveraging components of your portfolio, we don't want to do that with 50% of your portfolio. We want to do that with relatively small managed components, because while that can be a diversifier, it can also have, much more volatile returns. So generally, when we're looking at different components to diversify, we manage their size based on the volatility that those, different components will have. So speculative leverage strategies are, of course, going to have much more, higher return volatility there. Here we also kind of talk about some of the other ways. I mentioned selling calls, but protective puts, that's a great hedge in this type of market scenario. That said, one comment I have is, puts are expensive in these markets. So, kind of going back to what I was saying at the beginning, if you are looking at this market right now, if you're going, oh my gosh, I'm down 15% year to date or more, if you're not in the S&P 500, and you rush to buy puts, they're really expensive now. Like we saw, VIX printed 60 this morning. So that indicates a lot of speculative demand for puts. And, just one of the things I'm noting is in this environment, the spot vol correlation. So to the extent that people are rushing to buy puts and there's over demand for hedging or for hedges, then we're going to see the VIX spike more than the S&P goes down. So to the extent that vol is going up faster than it typically does when the market goes down, that usually indicates over demand for those hedges. And we don't want to be part of that paying up for hedges market. So, it sounds trite, but the best time to buy protective puts is when not everyone else is buying protective puts. We saw, during the drawdowns in 2022 that hedges were very well priced. So what you're looking at in terms of diversifiers, you've always got to be concerned about the price that you're paying for that different strategy, because at the end of the day, your portfolio is built up of a bunch of components, and each of those components returns is going to be solely a function of the price that you paid. So whether you're selling calls, buying puts, selling straddles, buying strangles, always be concerned about the price you're paying. And when using options as a diversification tool, you got to be very aware of the market environment that you're trading in.
Oh yeah. Do we want to take a look at an example of where maybe an at the money put is priced right now if we were to try to protect? Do you have any tickers in mind, Mark, that you'd want to take a look at?
So one of the benchmarks that I use is, oftentimes I'll have clients come to me and say, I want protection against the market. And in good times, and actually we can go and pull up a long dated SPX put, but roughly the cost of annual protection in the S&P 500, somewhere between 7 and 8%. So if on April 7th, 2025, you want to buy a put for the next year, you're, to protect yourself against a drawdown, you have to pay almost 7 or 8% of your portfolio, which actually conveniently is fairly close to the annualized return of the market. And so, I think it's really important for investors to know just how expensive naked protection can be. We of course can reduce those costs by, hedging it out with a put spread or, only going further out of the money. But at the monies tend to be pretty darn expensive. Like looking at the March quarterly, spot and SPY right now. Now, of course, we have to consider forward value and all that type of things. But if we're just looking purely at, at the money SPX level, I have no idea where we are in the last 10 minutes. The market's moving that much. But 49.75 is probably the closest strike. That puts $412. So, that's just about 8%. So if, you're not going to pay out on that put unless stock goes below, unless SPX goes below, 45.75. Otherwise, that's, just burned cash. And so you can sell calls to pay for that put. Like I said, you can do a put spread, you can go further out on money, lots of different things, but just understanding how expensive pure protection is kind of the first step, I would say, in evaluating pricing.
Yeah, it is quite expensive. And I was looking for some irresponsible lotto plays for these long dated options, just to see if I can get anything decent for like $10. And then, if the market rallies over the next 2 years, that $10 could turn into $100. I like to dream a little bit.
We're all dreamers.
So one of my favorite kind of, rather than thinking about totally like protection as like outright buying a put, you could think about something like the most simple, this might even be a whole episode on its own, but like the most basic structured product is the combination of a T-bill and a call or a call spread. So something to think about would be, okay, I can buy 100 shares of SPY for $500 right now, roughly. So I could take 50 grand and put it in T-bills, or actually I'm going to put the discounted amount. So if T-bills are given, I don't know what the 1 year bill is right now, probably let's say around 4%. I'm going to discount 4% from my 50 grand. I'm going to take, so I put, $49,600 into a T-bill. I'm guaranteed to get my 50 grand at the end of the year, so long as the United States still exists and is paying their bills. And I use the difference there and buy a call spread. So I take the extra $600 of interest that I'm going to get over the course of the year. And no, it's going to be a little more than that. But whatever, I take the expected amount of interest that I'm going to get from a zero coupon bond and use that to buy calls or call spreads. And that will give you the downside protection because your money's guaranteed in the bill. And you get the leverage from that call or call spread or whatever you choose. You could buy an at the money call. You probably won't be able to afford all that, but like you can go increasing degrees out of the money spreads. Of course, a million combinations you can do there. But that's a good way to stay totally protected with a little bit of an upside kicker.
Yeah, it's like when you go to the casino and you play roulette right away, and you just want to get up $100, so you have $100 to play with for the year, or for the rest of the night. Where that's like what you're gonna earn on your T-bills, right? You win that house money up front, you get that to play with, you got it in pocket, it's guaranteed. Although roulette is not guaranteed.
Certainly not.
But then you
I can't be part of any show that says that.
But then you just kind of throw it out there, and then hey, if you hit, you hit, right?
Yep. And of course, to be clear, you're giving up the opportunity cost of that interest, right? Yes. Like we're just talking about absolute SPX levels. The reason that forward value exists is because the cost of money is expected to be 4% over the next year. So, there is that opportunity cost of purchasing power, so to speak.
Right. Absolutely is.
No free lunches out there, other than diversification.
There you
go. Golden rule. Awesome. Incredibly helpful. There's not a more important time to be diversified than right now. So knowing how to use options, both short-term and long-term, the more you know, the better. So keep an eye on everything out there and tread lightly. But I think that may be a good opportunity.
One more thing to mention is there's diversification in what you're trading, and then there's also diversification in the tools that you're using. And here's a plug for this Wednesday. We have the Tradier Options Summit, the future of trading, where you could learn about a lot of different AI tools that are in the market. And myself and Dillon actually have a time slot in this schedule. So tune in at 2:45 Eastern.
As does Mark.
Wednesday.
Yeah, I was going to say, I will be there too.
Guys, I was getting there.
Oh, sorry. It didn't seem like you were. Go ahead. Continue.
I was just saying, tune in at 2:45 Eastern to see me and Dillon, and then stick around because there is an expert panel talking about the future of portfolio management. There we go. There's our guy, Mark Phillips, getting ready to speak. Mark, do you have any idea what the questions are going to be? What are you guys going to be talking about?
So we're going to be talking a lot about how to use and how I'm using and other panelists are using AI tools to help manage portfolios, whether it's to identify opportunity, build back tests, generally analyze the market using some of these new tools out there.
Excellent. Great group there that you're presenting with. We're familiar with David over at Inside Options. He's fantastic. So very cool. Yeah, we're looking forward to this Wednesday. You can get signed up at summit.tradier.com. Ourselves, Mark, and a ton of other great Tradier partners and speakers will be involved. And of course, you'll get to hear from Dan over at Tradier as well to wrap things up. Or actually to start things off as well. So future of trading, automation and AI. Tune in Wednesday, April 9th. So
it's free.
It's free. How could you not? Have it on in the background while you're working. So, all right. Excellent. What I think we can do, I know we got a little less than 15 minutes to the bell here. You want to take a look at some economic events quickly, just see if anything else is going to rock the boat this week, and then we can get out of here?
We could do that. Yeah, you want to get my screen up real quick?
Yeah, let's do it.
Nothing major today. Looking at tomorrow, also looks like nothing major. I don't think we'll be getting condors just due to the volatility that we're seeing. On Wednesday, things start to get a little bit spicy. We got a Fed speech and a 10-year note auction, FOMC minutes on Wednesday. Now, those are just the minutes from the previous FOMC meeting, but that does move the market sometimes. Sometimes when you're reviewing those minutes, you pick up something that maybe you didn't previously. And then Thursday, we talked about inflation. Thursday, we also have a 30-year bond auction. And then moving into Friday, we've got PPI data pre-market. We got the Michigan Consumer Sentiment Report, which has been an iron condor bomb over these last couple of months. So we will look to avoid that so we don't blow up our condors. And so it looks like today and tomorrow, fairly non-eventful. And then Wednesday, things start to heat up.
Yeah, I think everything's going to be big on the macro front this week. I think these economic releases will, the reactions to them will be dependent on whatever else is going on in the market that day.
Oh yeah.
I don't think they're the drivers. I think they're the tail.
Yeah, that's true.
Absolutely.
It's definitely true.
Awesome.
Yeah. So be safe out there.
Yeah, it's a lot of opportunity, a lot of risk. So know what you're doing, and not financial advisors, at least Ben and I here. So don't take anything we say too seriously. But I think that's it, guys. I think that's it. Thank you so much for tuning in. Of course, we'll be back here same day, same time next week, Monday morning, 8:30 a.m. For Man and Machine. And we'll be live Friday for Automation Station. But again, most importantly, tune in middle of the week, Wednesday, April 9th for the Future of Trading Summit, Option Summit with Tradier. Go to summit.tradier.com. And we hope to see you there. So thank you so much. And as always, we'll see you at the peak. Take care, everybody.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.